You mention assets under management in your letters regularly. Why should I, as an investor, care about the firm or the fund's assets? And another question that we combined with it is, at what size assets would you expect to close the fund to new investors? Let's see, turn off. I pressed the button. I mean, we've talked this at a couple of letters in the past. The way to think about this question, I think, is there are benefits to size and there are drawbacks to size. On the benefits side, as we get bigger, we gain economies of scale in many operational aspects, especially in terms of the cost of custody. John is looking at me. He works for Northern Trust. Cost of custody, execution costs. Jeffrey is looking at me here. Administrative costs. There are a lot of economies of scale that come to the fund as asset size increases. So basically, the total cost of investing $1, if you have 100 million, is a lot cheaper than the cost of investing $1 if you have 1 million in assets. So that's one big chunk that gives us substantial economies of scale up to a certain level. The other benefit that comes from size, but at a much higher level, is access to deals that the average investor may not have access to. This is a much higher size, and obviously a theoretical question, a theoretical comment to make about the fund today. But think of Buffett getting access to deals during the great financial crisis by providing liquidity to Goldman Sachs or to GE or later to Bank of America. That obviously happens at a much bigger size. On the drawback side, however, there are drawbacks to size. As the total amount of assets grows, the universe shrinks. The opportunity set of where a fund can invest becomes smaller and smaller because a $10 billion fund cannot invest in a small cap. Though a lot of that relates substantially to the type of strategy that you're running. A fund such as ours that holds some investments, in some case for 10 plus years, may not worry a lot if there is no daily or weekly liquidity on all its positions. But it does become a problem, and it impacts how quickly you can get in and out of positions, essentially. And so that's another a drawback to size. And on the management team side, there are also drawbacks to size. There are benefits up to a certain scale. You can get more heads and more efficient, but at some point you end up with too many people at the firm. Someone needs to manage them. You need to recruit people. You need to always find new people who are competent and at some point that becomes a challenge and a drawback to size. As it relates to us, I think our portfolio today can scale very easily to about $500 million. I think with small tweaks, we can easily get to $1 billion. And I also think that in what we do above $10 billion, it becomes challenging. And the drawbacks outweigh the benefits. Between the 1 billion and 10 billion levels, I think there are certain environments where the pros would be bigger than the cons and vice versa. And so to address the second question about closing the fund at what size, I think as we approach the 1 billion mark, that question is going to be one that we have to address seriously and look at the market environment. And one solution that people have done in those cases is to have a close but be able to open when market environments are conducive to that, and then return capital when they're not. But I hope we face this bridge very soon.